to fund its transition. Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about Idemitsu is that it currently trades at a price to book of 0.7 times, meaning less than 1 times price to book. This is Andrew Stotts of the Valuation Masterclass. Let's get started. Remember, this is for information purposes and learning purposes only. It's not investment advice or a recommendation. Idemitsu is in the energy sector in Japan. It's the second largest Japanese petroleum refiner and operator of more than 6,300 gas stations across Japan. The question is, can Idemitsu Kosan generate enough cash from oil to fund its transition? There's 3 things to know. First, slowing oil consumption could result in declining revenue. The ramp up of CAPEX is necessary to ensure longevity of the business. An attractive dividend yield could rise to 2 times the Japanese average. Let's review some key statistics. There's 9 analysts covering the company, and the price is their target price is Japanese yen 3,360. That's a 14% upside or a buy. The PE ratio is about 11.6 times, and dividend yield is very high at 4%. My value estimate is about Japanese yen 3,595, which is an upside of about 22%. So I'm a bit more positive than the market, but both of us are positive. Now, let's review the sales of the company. The revenue breakdown: petroleum is 78%, chemical is 7%, materials 7%, power 4%, and resources 4%. This is a Japanese company that's mainly serving the Japanese market. Almost 80% of its revenue comes from Japan, and about 14% comes from Asia. Only a tiny 6% comes from North America. Now, the share price has been on a run for a while here throughout the year. The 50-day moving average has stayed above the 200-day moving average, which is a strong bullish signal. The share price is up 33% year to date, and volume RSI is stayed above the 50% line, which has been positive as well. Let's go through the story of this company. Number 1, slowing oil consumption could result in declining revenue. Here you can see a chart that shows crude oil consumption in kiloliters, millions of kiloliters for Japan. And it was 200 million kiloliters, and it's already down to about 150. That's over about the last 10 years. So Idemitsu is still heavily reliant on its petroleum segment, which constitutes 80% of its revenue. Over the past 10 years, crude oil consumption in Japan has declined every year by 3%. Why is oil consumption declining in Japan? Well, one of the things is it's an aging society, so there's less travel and the like. Now, this trend might even accelerate after 2022. Of course, there's a transition to renewables that's also a part of that. Now, the company should focus on generating cash from oil to fund other segments. That's really where the focus is here. Now, let's talk about issue number 2, or story number 2, which is a ramp up of CAPEX, which is necessary to ensure longevity. In the past, Idemitsu has been rather conservative in its expansion strategy. CAPEX to depreciation ratio has even been below 1 times in the past, meaning they're not even reinvesting enough to cover the deterioration of existing assets. But in 2022, we're expecting, and onwards, we're expecting that to rise. In its new alignment, the management is focusing on expanding into other segments to compensate for a falling contribution from petroleum. CAPEX budget for the next 3 years is Japanese yen 550 billion, which is much higher than in the past. Now, transition takes time, but should pay off in the future. Here, I show a diagram that's showing the transition from energy and material transition and away from that and into advanced materials and next generation mobility and community, and then renewables. By 2030, the company plans to increase its renewable capacity to 4 gigawatts from the current 0.2 gigawatts, so a massive increase. In addition, it plans to shift from coal production to gas. Also, it allocated about 100 billion Japanese yen for M&A budget to expand its chemicals and materials segment. I think that the market is too pessimistic about the long-term outlook at this company. Now, let's talk about the attractive dividend yield, which could rise to 2 times Japanese average. The chart that I'm showing on this page shows the return on invested capital, which has fluctuated from as high as 13% in 2018 down to a low in 2020 of about 0. And currently, it seems to have rebounded back to about 6% or so. Now, the cost of capital we estimate to be about 5.75. And so ultimately, the challenge for this company is to keep its return on invested capital above the weighted average cost of capital. And it hasn't really done a great job of that right now. Now, that's part of the reason why a company trades at a price to book that's below 1, because the company is either destroying value or just not making excess value. And that means that the return on invested capital is about in line or less than the cost of capital. That would be bad. The company's likely to maintain its dividends per share and could result in a massive dividend yield of about 5%. The dividend has been rising over time, and right now it's at about 4%. Remember, you can scan this QR code to go to the valuationmasterclass.com or just go to the website and go to blog to download all full case studies reports for free. This particular study will be up very quickly after. So I see James Foong, good to see you from Malaysia. Awesome. Let's continue. The FVMR scorecard measures a stock's attractiveness relative to other companies. And attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. We look at a scale from 1, which is best, to 10, which is worst. And here you can see that I'm going to focus in actually on almost every measure. This company looks pretty good, but let's focus in on valuation. If we look at the past 12-month data, a little bit different than annual data. I like to do a rolling month, quarterly, basically, data. What we can see is price to sales is about 0.2. That's crazy cheap. Very rarely are you going to see a company that cheap. Now, it may stay that cheap if they can't accelerate their earnings. Now, PE in the past 12 months is 3.6 because of accelerating earnings compared to what we saw on the front page of a higher PE. And then price to book is about 0.7. So it's below book value. Before I go into it a little bit more, I just want to mention this concept because it's such a core concept in finance, and that is having the return on invested capital above the weighted average cost of capital. The difference between these two is what you would call value added. It is the actual value creation of a company. Think about a business. It's very simple. We bring in money into a business and we allocate that money to assets and expenses and employees to try to get a return. How much do we pay for the money that we get? Let's say we pay 7% total, some amount to debt holders, some amount to equity holders, but let's say it's 7. Our objective is to try to run that return on invested capital way above 7. Imagine if we could get it to 14. That means we'd have 7 in value creation. If we have 7 in value creation, that means 7%. What's going to happen to the price to book? Price to book is going to go up quite considerably and be at a premium to the book value. But if the company has a weighted average cost of capital of 7 and the return on invested capital comes down below it, then you have a case where you are likely going to see that the price to book is actually below 1. Now, let's go back to the story here. Recently, I created a short online course explaining my FVMR investing approach. And I usually sell it for $97, but for a limited time, I'm offering it for free. Just scan the QR code or go to the link that's in below. And now I see Lee's there. Good to see you, Lee. What would you say is an average ROIC? That's a good question. I would say that the average ROIC is about 8%. I can try to answer that question more specifically. And if you want me to, I can do that by just going into, let's just do that. I'm going to go into a file that I have, and let's just go into this Excel file and see it. I think I've got it stored. Whoa, got a lot of data here. Hold on. I've got it stored here, and I'll be able to open it up. 1 second. And I'm going to tell you that exact number. Hold on. Okay. So to answer that question, I'm going to open up this file. This file has all of my data for all the companies worldwide. And here you can see, I'm going to just show you this research right here. This is a huge, huge data set that's coming out of this. And we're just going to look at global for a moment. And what are we going to look at? We're going to look at the calculation of return on invested capital. And here it is at the bottom. So actually, it's about 10%. Sorry, I was a little bit low. And what we can see here is that different sectors, the highest sector for return on invested capital is infotech, and the lowest sector for return on invested capital is utilities. So this is a good little snapshot. We teach about this in the Valuation Master Class. For those people that are going to attend the upcoming boot camp, they'll be able to see all this data, and it's amazing. We got a lot of stuff out there. So let's now go back to the forecast, and what you can see is that analysts see a small upside but remain cautious. There's 9 analysts covering the company, and the upside that they're expecting is 14%. Now, currently, there's no catalyst in place that would lead to excessive optimism right now. So most analysts are at a hold. Consensus expects a record revenue in 2022. Yeah, that's driven by oil price, but also expecting that to fall a bit, and oil prices is highly volatile. So let's go in. Before I go into the financials, let me look at the next questions. Satawat says, do you think that they can actually achieve their 7% target? I think they'll achieve it when oil prices are high. The risk that they run is if oil prices come back down, I think it's going to be very hard to achieve. So let's continue on and look at the profit and loss statement. And here we can see that the strong bottom line mainly is driven by oil. So in 2020, the company was at a loss of 23 billion yen, but they recovered as oil prices recovered in 2021. And in 2022, they're probably going to see high oil prices throughout. The Japanese government announced to release some of its oil reserves to prevent a further spike in price. But truth is, everybody's chasing oil price right now. It's not easy to bring it down. Now, let's look at the balance sheet assets. A key element here is that the cash to assets ratios is about 3%. So the low cash generation ability might result in conservative expansion plans. Now, let's look at the liabilities of the company. Idemitsu has moderately high leverage, but its net debt to equity ratio stood at about 0.9 as of 2021. Now we can see, if we look at the chart that I have right here of the liability section of the balance sheet, as of 2021, they had about 552 billion yen in short-term loans and 757 billion yen in long-term loans. Let's look at some other ratios. Unlike other petroleum companies, Idemitsu has a very high efficiency level, meaning efficiency is related to the amount of revenue that they're generating in relation to the assets that they have in place. So let's continue and look at the gross profit margin. In 2021 and 2022, it continues to stay high. What we're having is about 10 to 12% due to really a high oil price. Let's look at the valuation of the company. Let's review the A-Stot's investment research stock picking checklist. It's inspired by Peter Lynch and his 10 baggers. That means stocks that have gone up 10 times. It's based upon extensive research, as I went through with the team, all the 10 baggers that we could find. And we went back to when they weren't 10 baggers and tried to figure out what was different about them. There's 9 factors that drive long-term share price performance according to our research. So the first thing is management, that management has a proven commitment to growth. Here, I would say it's weak. Currently, there's a lack of strategy of how to compensate for declining oil revenue over time. Number 2 is growth. Product and industry can support growth, a decade of 10% plus annual growth. Weak. Oil consumption in Japan is continuing to shrink. It's hard to invest in companies, in that case, from a long-term perspective, or see them go up by 5 or 10 times if we don't have at least 10% annual growth. Sustainable. Well, competitive strategy creates sustainably high gross profit margins. That's moderate. Its gross margin is similar to its closest competitor. And if we look at quality, number 4, earnings quality, good earnings quality, non-core items are small or non-existent. And in this case, I'd say it has weak potential. Earnings fluctuate quite a lot given the industry's volatile nature. And here you can see that's part of the issue of this company. A lot of things are weak right now. Now, efficiency is in the long run, sales grow faster than assets. Now, the company is characterized by remarkable efficiency. Asset turnover is about 150%. Number 6 is tight, relatively low cash conversion cycle. Negative would be best. Here it's moderate. The cash conversion cycle is moderately high and stood at 60 days in 2021. Number 7 is cash flow. The company, the operating cash flow is consistently positive. That's moderate. Operating cash flow has been consistent over time, but not always able to cover investing outflows. Number 8 is capacity. The company has access to capital to fund growth. Moderate. Leverage is moderately high. It's not like they can just line up a ton of money at this point. And number 9, inexpensive. Valuation is reasonable. Avoid stocks, of course, that are too expensive. Here it's good. It's cheap on both a PE and a price to book basis compared to Japan energy companies, and it's about in line on an ROE basis. If I sum all this up, I'd say this company is not going to be a 10-bagger. Yes, there's upside that we've identified, but I wouldn't expect it to be a 10-bagger. Now, the free cash flow of the company is likely to remain volatile given the abrupt changes in working capital, which is happening all the time with this type of company. Now, value estimate, let's look at my assumptions here. I expect a higher revenue drop in 2023 and 2024 than consensus. So in other words, I'm factoring in more negative numbers on revenue, but we can see that net margin stays about the same. Now, however, my long-term outlook is a bit more optimistic. Idemitsu should be able to focus on its other segments to diversify away from oil. Historically, Japan also has had a very low risk-free rate. You can see that I'm using 0.5%. That is crazy low risk-free rate. In fact, right now, I was talking to my sister this morning back in the US, and she was telling me that a housing loan now used to be at about 2 and 2.75%, which is crazy low, and now it's already above 3. It could be as high as 3.25. Thank you, Amornrat. That's very nice. It is an informative slide, and we've got a great team putting it all together. Now, the cost of equity is about 10%, and WACC is about 5.4. Terminal growth rate is 2. You can see that WACC is half the size of cost of equity. Why? Because the cost of funding for the company in this very low interest rate environment is super low. So let's look at the free cash flow valuation method. And here, the base case that I've come up with is Japanese yen 3,595. That was what I think is value, and that gives an upside of 22. The bull case would be an upside of 31, and the bear case, an upside of 14. So even if you get it wrong, you still got an upside of about 14. Let's look at the world-class benchmarking scorecard for this company. We identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth. The scale is from 1, best, to 10, worst. Here we can see that Idemitsu ranks among the top 20% worldwide when compared against 310 large energy companies worldwide. The ranking is a 2. It was as low as a 9 in 2020, but it has come back significantly. If it's a green, that means it's a 1 or a 2. That means it's world class. The profitability has been rising from a ranking of 9 to 5 to 3 recently in the most recent past 12 months. And growth also has had a tremendous turnaround. Again, a lot of this is driven by oil price rise. So what are the risks? Well, the key risk is high dependency on oil. Adverse regulatory changes could accelerate the phase out of fossil fuels. We've seen that happening in Germany, and they're squeezing themselves. And failure to identify suitable expansion opportunities for non-oil business segments, and lower than expected operating cash flow could hamper expansion plans as the company has not much cash reserves. So what's the conclusion? Petroleum segment strong in short run, but does not ensure longevity. Management's plans to expand other segments should drive revenue growth in the long run. And a 5% dividend yield at cheap valuation might be already attractive enough. So let me ask you the question. My question to you is, can Idemitsu Kosan generate enough cash from oil to fund its transition? Please share your opinion in the links below.